Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for tuning in. Watch the channel, subscribe, and all the comments. I greatly appreciate it. Today, we're going to look at Alibaba behind me. Before we dive into it, I'll cover what we always talk about in this channel, which is free cash flow. That is the value that underpins all investment. We as value investors hunt for free cash flow. That's what we buy. That's what we like to see stack up in the bank. So to do this, we look at for 5 key attributes for all of our investments. The first one being top line revenue growth, gotta have it. Second is EBITDA growth. That's earnings growth, gotta have that. Strong free cash flow, a low debt, that means a strong balance sheet, which is defined as debt to EBITDA of less than 3 times, and a well-priced stock. Well-priced, we use enterprise value divided by EBITDA as our value measure. Please check out my Domino's versus Google IPO video. They both IPO'd the same year, 15 years ago, but Domino's has outperformed Google over the last 15 years because you could have purchased Domino's so cheaply when it IPO'd. So please check that one out. Let's dive into Alibaba. Behind me is the 10K. So their 10K is as of fiscal year ending in March. So this is going to be March 2020 is their fiscal year. All these numbers are going to be as such. I've used my own currency conversion. I come up close to numbers, but there'll be slight discrepancies. Forgive me. There's a lot of data here. I'm trying to do it quickly to get these numbers out, given the stock has recently taken a dip, but I think it's really interesting. For reference, I am using the average exchange rate for the fiscal year on the income statement and the cash flow statement, and I'm using the point end date being March, that month's average exchange rate for the balance sheet. So income statement, cash flow, receive the average for the year. The balance sheet receives the average for March fiscal year end exchange rate. Okay, let's dive right in. This thing is really, really interesting. Recommend you read it, walk through it. It's fantastic. The first thing I want to show you is just the sheer size of the business and kind of how long-term they think. So here they go, their vision, 102 years they're looking out. I think that's incredible. Kudos for them having such a long-term vision. Also, the first couple of slides in here goes through exactly how big of a beast they are with the number of transactions exceeding $10 trillion RMB, which is a huge number annual consumption on their platform. Absolutely a beast. I don't think anyone's arguing that. The question is, how much cash do they make, and are they overvalued? So let's get through this. The first thing I want to discuss is actually on slide 19. This is their portfolio of companies that they own. The bottom one here being Ant Group, which is very, very interesting. You got to read the footnotes here. I highly recommend always read the footnotes. It says that they own 33% of Ant Group, and they account for it on the equity method on the balance sheet and the income statement. What does that mean? That means that Ant Group is not consolidated. It is just a one-line statement on the income statement, and it's in the other income and investment line. And we'll show it later on, but it's one reason when I look at EBITDA, I try to get above that line. So I'm looking at what are the earnings of the business as a whole, being Alibaba, and not intermingling with other investments that they don't have control over, such as Ant Group, where they own 33%. Let's keep going. The next statement I want to look at is on page 109. 109 is just their general revenue distribution. So here, where do they derive the revenue from? You can see 65%, this is RMB, this is USD, 2020 fiscal year. I'm on page 109. Most everything comes from their e-commerce business. The rest of it is all pretty single-digit numbers. It's diversified, but not for the concentration of e-commerce. So they're an e-commerce. All right, that's it. Just want to cover that. Let's keep rolling. Next page, please. 281. 281 is their income statement. So what they do is they give you 3 years of financials, which I like, and then the last year, the most recent year, they convert into dollars. So you've got 18, 19, 20, all in RMB or the yuan here, and then USD over here. And again, my numbers differ slightly. I don't know if they're using maybe a different calculation for the way they do the exchange rate, but we get close. But please do your own numbers. What I wanted to point out, obviously, super strong top line revenue growth here. $250 billion, 250, these are million. This is 250 billion won, 376, 500 billion top line. Fantastic. And then if you come down, you'll see this line here, interest in investment income. This line is their Ant Financial and others. And so you'll see that this is business operations, operating income, the income that they make from their basic businesses that they control, basic. But the business they control, and then right below it, that's income from investments under the equity method. And so we're going to exclude that when we look at EBITDA. I want to look at what they're making on the business, and if they're able to IPO Ant and get a huge multiple, that's going to be gravy on top of this. But I want to see what they generate from the e-commerce business as a whole. Let's see. What else is interesting on this? Oh yeah, shares outstanding. So shares outstanding, typically you'll see it on the income statement. When you're reading through the income statement, you get all the way down the bottom. After EPS, it'll typically say shares outstanding, basic and diluted. You can pull either one depending upon what kind of numbers you're running. But here on this statement, these shares are higher than if you look at Yahoo Finance or Google Finance or some of the stuff in the States. Why? Because these are shares on the Hong Kong Exchange. When you convert it into ADS, the American Depository shares that are on exchange, they do an 8-for-1 reverse split. So you want to take these numbers, divide by 8, and you'll get the number of shares posted on Yahoo Finance and others. It's the numbers I use, so all of my shares are being fewer than these because I've divided by 8. But a good footnote, again, always reading these documents. If you're buying this company, you're going to own it for a decade. Read the report. Takes you, it's a 300-page report. It'll take you a while. You don't have to read everything, but definitely dust it off once a year. Get a whiskey or a coffee, whatever you need to go through it. Next one I want to show you is the very next slide. The gleaming, shining balance sheet. Maybe it's 2 pages down. Balance sheet. Absolutely incredible. They have a tremendous amount of cash. I'm going to point to the dollar column here. Let me just so you can see there you go. There's the headers. So 19, 20, 20 in USD. I'll stick to the dollars because it's just easier to talk to. But cash, $46 billion of pure cash sitting in the checking account. Then they've got short-term investments, which is also cash, $4 billion. This is a huge number. And what I have done is they don't need all this cash. They don't need $46 billion of cash to run the business. So I'm taking some of this and I'm adding it to this when I do the cash add back because it's just way too much. They don't need it. So I think I'm pulling off almost half that recent number. So another $20 billion. I lump it into the $4 billion of cash flow from investing from my excess cash, but I can cover that later. But what I wanted to get to is here, total current assets, $65 billion. And when I look at total current liabilities, all liabilities, $61 billion. So they're telling you that they have enough cash, AR, and inventory to cover all their liabilities, including some of the long-term debt here, non-current bank debt, non-current unsecured notes. This is the long-term debt that we're principally concerned about. We also, I think they had a senior note, current unsecured note. A couple years ago they had it that we would look to. We do not consider debt when we're looking at the enterprise value. Some of these other things on here, merchant deposits, that's part of doing business. It's not like a financial obligation like a bank note is. Deferred revenue, again, not an obligation. That's revenue that they've received but they haven't booked yet. So it's not the same thing as taking a mortgage out on assets where it's not a risk of bankruptcy, in other words, if they don't pay it. So don't use total debt when you look at enterprise value. You want to pull out particularly the items that have duration, typically long-term duration, meaning time frame, and strict covenants, obligations that you have to pay it back. Last thing I want to do is just touch on the cash flow statement, trying to move quickly here, and then I will show you my numbers here. So this is the operating cash flow, right? So this starts with net income, all the operating adjustments they're adding and subtracting for what is non-cash or what is cash that wasn't on the income statement. That's what they're doing here. And what I want to direct you to is the gain here for the financials, $10 billion. That $10 billion is reflected in their income statement. If I go back up to the income statement, here we go, consolidated income statement, investments and other interest, right? $10.3 billion. right? So that is the gain on the equity value that they have in Ant over that year. But because it was not cash, they have to subtract it from the cash flow from operation because it's an accounting gain. It's not actual cash. They have to IPO it, sell the investment to actually realize it. So when we look at EBITDA, and EBITDA for us is a proxy for cash flow, we want to remove things that aren't cash to try to get a general idea of what earnings for the company is. All right, that's enough. I've gone through the Alibaba 10K. Please read it. Actually, it's 20F because it's a foreign company, but it's please read it. Let's go dive into the numbers and see what we think. What do we like? What do we don't like? How fast are they growing? What's the forecast? What's the value of the business? Here we go. These are my numbers. I have taken their RMB, converted it into US dollars on the average exchange rate for the year. So revenue 2012 to 2020, fiscal year ending March. Remember, all March. So $3 billion to $75 billion annually. And EBITDA just shy of $1 billion, all the way up to $20 billion on an annual basis. That is a 47, can we say 50? We can say 50. 50% annualized growth rate over those 9 years, which is incredible. Absolutely amazing. Revenue and earnings growth, definitely check the box there. Debt gone from 0 to $21 billion of debt. I'm not too concerned about that, again, because they make $20 billion a year at annual EBITDA, so 21 is 1 times debt. That's no problem. Cash is monstrous. It's gone from basically 0. It's just shy of $1 billion. $1 billion for you guys is almost 0. That's incredible. To $20 billion. And like I said before, what I'm doing is I'm adding to the excess cash flow line because they have too much cash in the balance sheet, so I'm pulling some of it down. It's a little arbitrary. Yes, you could make it 25, you could make it 15. I pegged it at 20 as a nice kind of round number. Market cap, shares outstanding times price, enterprise value, add the debt, less the cash, plus the stock gives you enterprise value at just under $1 trillion, excuse me, $500 billion, $523 billion. Now, when I look at multiples, all right, they have gone from 46 times enterprise value to EBITDA to 25 times. 25 times is cheap in my book for a company that's growing this fast. 35 times, it's okay. Might be a little rich, given that it's traded a little lower than that at times, but it's not unreasonable for a company that's growing this rate. And with 0 debt, effectively debt to EBITDA is 0. They're in a very strong balance sheet position, growing very quickly, lots of cash piling up at the balance sheet. Good, strong starting point for our analysis. Let's go through cash flow from operations. So cash flow from operations, the number 9 years that they've had, let me move this over so you can see a little bit easier. $1.3 billion to $26 billion, that is a growth rate of 45%. That growth rate dovetails nicely with the 50% growth rate that we saw in the EBITDA. CapEx, very, very low. It does not take them a whole lot of money to put back in this infrastructure. That means that of this $20 billion that comes, $26 billion in cash that they made, $6 billion going back into kind of CapEx, leaves a lot of money, almost $17 billion on free cash flow left over at the end of the year. They have a little bit of debt in terms of payment, but again, it's almost 0 in terms of its impact on the enterprise value. So I'm hopping over it because they could pay it all off easily, and then all this cash would go through the equity holders because I don't want to lower it for the $2 billion. So this 17 is the sum of all these, but I would say that 17 is closer to 19, frankly. Shares outstanding have grown slightly. They do issue shares slightly every year. That's probably based on employee stock comp that they just don't buy back. Free cash flow per share, $6.66 last fiscal year. And then on a price of $194, gives you a 3.4% yield, just dividing the two. So let's recap. Earnings growth, yes. EBITDA growth, yes. Low debt, absolutely. Strong free cash flow, yeah. So I think it checks all those boxes. Let's see what price action looks like with the forecast. So what we're going to do is we're going to forecast. I've looked in the street to see what kind of is out there, and people are saying around $30 billion for 2021 EBITDA target for Alibaba. If you believe that, we're going to go forward with these numbers. $30 billion. I've taken that 50% year-over-year growth rate, which is strong, and I've pulled it down annually because I just don't know what's going to happen in the future, and I can't continuously believe that they're going to grow that 30 billion at the same 50% annual growth rate. So I'm bringing it down with a long-term target of $132 billion. Not unreasonable. Some of the long-term forecasts I have seen do show numbers that are around that $120, $140 billion range, even as soon as 8 years out. So it seems reasonable that they could hit it. Do you want to pay for it? I don't know. But this is saying $134 billion at the end of 2030. I have given it a 20 times enterprise multiple. Again, as it growth comes down as from size, market multiple will come down as well. And a 20 times handle is very reasonable for a company that's this size and still growing. Less some debt plus some cash based on historic ratios gives me a market cap of $2.6 trillion. Divide by the shares that are outstanding gives me a price target of $978 in 10 years. Okay, let's take this growth forecast. Let's put that in here, and let's talk about the free cash flow to shareholders growth rate. So this $9.88, that's me taking CFO. This is the average. I've taken the average the last couple years free cash flow. Remember I said that I didn't necessarily trust this $2 billion is really an outflow. It's real, they paid it, don't get me wrong, but they have so little debt, it kind of unfairly burdens the cash flow that year. You can see the other years they didn't pay it at all. So I've just averaged these 3 years to come up with that number. So here we go, $9.88. Out 10 years with the same growth forecast gives me $42 a share, just shy of $43 per share of cash flow. I give that a 4 times multiple, reflecting the lower enterprise to value multiple. This is a 4% free cash flow yield. Gives me $1,074 as a long-term price target. Okay, now we have 2 price targets. I've got one based on a free cash flow to equity method of $1,074. I've got another based on EBITDA market multiple approach of $978. Average the two for a long-term price target of $1,026. If I put this target into an IRR calculator where I buy the stock now $270, I get this stream of cash flow, which, by the way, does not include an IPO of Ant or really any cash flows from Ant. It's just the free cash flow from the operations, assuming they dividend it out. Realistically, they would dividend some, they'd use some to buy back shares, or really it looks like they're just using it to go buy and make other investments that turned out to be profitable. But assuming they paid it out for a simplistic analysis, this would be the stream of cash flows. If I buy it at $270, I get this stream of cash flow and I sell it for just over $1,000. That's a 22% annualized growth rate over the decade, which is extremely strong. It's a robust number. It's very strong, and I think that it reflects the opportunity, the market opportunity that they have that they're capturing. You obviously need to believe in this forecast for this number to come true. Okay, it is absolutely dependent, mainly, on this next year EBITDA target of $30 billion. A 50% growth for next year is huge. It kind of sets the stage for everything else here. So if you believe in the forecast, I think it's reasonable that they could do it. Honestly, I think this is kind of where growth starts meeting value, and growth people need to look and allow a company to continue to succeed. And if you do it, it seems like a nice piece of a portfolio that, if you hit it, could do extremely well over a long term, and I like that. If I put it into an IRR distribution so we can get a feel for where this would go if the price changes. As the price goes up over 300, 350, the IRR definitely comes down, and I'm not sure I'd be buying it. But if it's 270 or lower on a risk-adjusted basis for me, that 22% IRR is certainly high enough to warrant putting dollars to work for what we've seen in this channel. And given some of the premiums that we can see for growth stocks like this here in the States, it seems pretty attractive to me. Behind me, obviously, these are my numbers, my assumptions. Take a look through them, run your own numbers, read that annual report, come to your own conclusion. But this is me. I'd love to hear the feedback. Let me know what you think. Certainly of the growth forecast, it's strong. Tell me what you think. My name is Cameron Stewart. This has been Alibaba. Thank you for watching. Bye-bye.